Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, July 2nd, 2026. We're recording at 12:30 p.m. Eastern Daylight Time. This is episode number 60, and I am your host, Scott T. Slayton, Chief Strategist at Capital Creek Partners. Here's the starting lineup. Number 1, the June non-farm payroll report. Softer headline, but the details reveal a still solid labor market. Number 2, real interest rates and the Fed path. Plenty of room to hike. And number 3, the shocking success of the Democratic Socialist Party of America. So back to the NFP. I like to focus on the 3-month moving average because these monthly prints have become very volatile. And the 3-month moving average for the June NFP reveals job gains of 111,000 on average over the last 3 months. May was revised down from 188,000 to 164,000, but this seems to me to still be quite solid, especially when you consider very low immigration. Nobody knows for sure whether it's a little bit positive, 0, or even negative in terms of immigration, but to still be adding on average over 100,000 jobs with that immigration background, I think is still pretty good. So average hourly earnings were right on the screws at plus 0.3% month over month and plus 3.5% year over year. This is really not a problem when you consider 2% productivity. So not a lot of inflation coming from wage gains, which I think is very good news. Average weekly hours, which I always keep an eye on this to see if the economy's slowing or not. And average weekly hours have been pinned at 34.3 for what seems like years. So this labor market to me feels like it's still in equilibrium despite the headline miss, which I wouldn't overly emphasize today. The unemployment rate ticked down 1/10 from 4.3 to 4.2. And the U6 underemployment rate ticked down from 8.1 to 7.9. And that underemployment rate is down pretty sharply from 8.7% last November. That's really good news on the labor front. Fewer people are underemployed. Now, some of these unemployment rates were affected by a pretty steep drop in the participation rate, which fell from 61.8 to 61.5. That definitely had an effect on those lower unemployment rates, just fewer people looking for work, according to the process. The real gains came from education and healthcare. They added 69,000 jobs in June, and professional and business services added 36. The losses came from leisure and hospitality, which shed 61,000, and information workers, which shed 9,000. So perhaps some of the big companies like Microsoft are laying off workers to help offset some of the costs of this massive capital spending on artificial intelligence. But it looks to me like the labor market is solid. There's little inflation from the job market. This number is just not enough to move the narrative on the Fed, in my opinion. Clearly, though, the odds of a 25 basis point hike at the July 27th meeting are somewhat reduced. I still think it's possible, but I think they're reduced. This is just not enough of a smoking gun to allow them to go, in my opinion. So the hawks probably have to wait until September. Now, I was inspired by a really good economics report by Joe Kalish and Vanetta Dimitrova of Ned Davis Research on real rates. And what their report revealed was that the real federal funds rate based on the CPI is now minus 50 basis points, which is the lowest since 2023. Of course, inflation has been rising and the policy rate has been stuck at 363, the midpoint of it at 363 since December of last year, after the Fed cut 3 times last year. So monetary policy based upon real rates is still quite accommodating in the context of history. And we know financial conditions are still quite easy, certainly according to the Chicago Fed National Financial Conditions Index and other market-based financial conditions indices like the Bloomberg Financial Conditions Index. Money is still easy. Financial conditions are still easy, which is bullish for stocks. So the bottom line here is the Fed, at least through the lens of real interest rates, has ample room to raise rates, probably by 100 basis points or more before becoming restrictive. We're not even close to being restrictive right now based on real rates. And so I don't think the Fed is really even close to posing a policy threat to either the economy or to the equity market at this point. So the AI bubble can continue to inflate without any fear of the Fed, at least for the next 6 months, in my opinion, based on real rates. Now, the Democratic Socialist Party of America had one heck of a week this week. And so I just had to think about this and ponder it in the context of capitalism, in terms of the equity markets, the bond markets, how much demand there will be for U.S. assets. And I had assumed that Zoran Mamdani's election last year was really a fluke, a tempest in a teapot in a deep blue city. But this week, on June 30th in New York, Democratic Socialist candidates won 9 of 10 races and really upended many of the very established Democrats in the House in New York. Also in Colorado, a woman named Malat Quiros, a 29-year-old student, shocked a 15-term Democrat in the heart of Denver's most liberal area. So what does this mean for economies and markets? I'm not sure, but it appears that this anti-establishment primary revolt is not really about encroaching Marxism. It's more about populism encroaching and seeping more and more deeply into the Democratic Party. The DSA is becoming a legitimate Democrat faction, not just a protest brand. And the DSA is showing consistently here, post Mamdani, a disciplined ground game, the ability to raise money, a lot of youthful volunteers out beating the bushes and banging on doors and generating a lot of urban turnout. Now, I think this poses limited policy risk today. The DSA has virtually no governing control at all outside of a handful of very large, very liberal cities on the east and west coast of the United States. But I think what it tells us is that Democrats are moving from what I might call technocratic liberalism to class-based populism. And that, I think, is long-term scary and long-term problematic for those of us who love capitalism and like to operate in free markets. So capital may face higher political scrutiny, with populists now insurging pretty deeply into both of our major political parties. So I think it's also interesting to think that the DSA is probably going to have a significant say in who the Democrats nominate for president in 2028. We'll get more data points in the midterms in November, but this is something I'm thinking about longer term, and I think it is a bit of a worry and a problem, though not a panic at this point. So do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate